Most people don't avoid the stock market because they're lazy. They avoid it because it feels confusing. The charts look intimidating. The news sounds dramatic. The terminology feels like another language. And somewhere in the back of your mind, there's always that fear. What if I lose everything? But Matthew R. Kratter's message in A Beginner's Guide to the Stock Market is simple and empowering. The stock market may look complicated from the outside, but once you understand the basic rules, it becomes one of the greatest opportunity machines ever created. Not because it makes everyone rich overnight, not because every stock is a winner, and definitely not because beginners should gamble with their savings. The stock market is powerful because it allows ordinary people to own small pieces of great businesses. You do not need to start a global company from scratch. You do not need to invent the next iPhone. You do not need to build the next Coca-Cola. You can simply become a part owner of companies that already exist. But there is a catch. The same market that can build wealth can also punish impatience, ignorance, and emotion. So this book is not about getting rich quickly. It is about learning how the game works before you put your money at risk. The stock market is not a casino, unless you treat it like one. A lot of beginners enter the market with the wrong mindset. They hear about someone doubling their money in a few weeks. They see a stock trending on social media. They hear a friend say, "This one is going to explode." Then they jump in without understanding the business, the risks, or the rules. At that point, they are not investing. They are guessing. Kratter's book is designed to prevent exactly that. He explains the market in a beginner-friendly way so you can stop seeing stocks as mysterious symbols on a screen and start seeing them for what they really are. Ownership in businesses. When you buy a stock, you are buying a small piece of a company. If the company grows, earns more money, and becomes more valuable, your ownership can become more valuable too. That is the heart of investing. You are not buying random letters. You are buying a business. And the better you understand that business, the better your chances of making intelligent decisions. What is a stock? A stock is a share of ownership in a company. Imagine a company is like a giant pizza. Each slice represents a piece of ownership. When you buy a stock, you own one tiny slice of that company. You do not run the company. You do not sit in the CEO's office, but you do participate in the company's future. If the company performs well, investors may be willing to pay more for its shares. If it performs badly, the price may fall. This is why stock ownership can be powerful. You can benefit from the growth of businesses that serve millions or even billions of people. But ownership also comes with risk. A company can disappoint. A business model can fail. Competition can rise. Management can make bad decisions. The market can lose confidence. That is why beginners must learn the basics before they chase returns. Market capitalization. How the market values a company. One of the first terms Kratter explains is market capitalization, often called market cap. Market cap is the total value the stock market gives to a company. The formula is simple. Stock price multiplied by the number of shares outstanding. For example, if a company has 1 billion shares and each share trades at $100, the company's market cap is $100 billion. This matters because the share price alone does not tell you how big a company is. A $20 stock is not automatically cheaper than a $200 stock. What matters is the total value of the business compared to its earnings, growth, assets, and future potential. Beginners often make the mistake of thinking low-price stocks are cheap and high-price stocks are expensive. But that is not always true. A $5 stock can be wildly overvalued. A $500 stock can still be fairly priced. The price per share is only one small part of the story. Investors versus traders. Kratter also separates two important groups, investors and traders. An investor usually buys stocks and holds them for years. Investors care about the long-term performance of the business. A trader buys and sells more quickly. A trader may hold a stock for a few days, a few hours, or even less. Neither approach is automatically good or bad, but they require different skills. Investing is about patience, business understanding, and long-term thinking. Trading is about timing, risk control, market behavior, and emotional discipline. The problem is that many beginners confuse the two. They buy a stock like an investor, but panic like a trader. Or they make a short-term trade, but when it goes against them, they suddenly pretend they are long-term investors. That is dangerous. Before you buy anything, you need to know your plan. Are you investing for years, or are you trading for a shorter move? What would make you sell? How much are you willing to risk? Without a plan, the market will create one for you, usually through fear. How the stock market works. The stock market is always trying to price the future. This is one of the most important ideas in the book. A stock price does not simply reflect what a company is today. It reflects what investors believe the company may become in the future. That is why stocks can move before the good or bad news becomes obvious. If investors believe a company is entering a powerful growth phase, the stock may rise quickly. If they believe the company's future is weakening, the stock may fall even while the company still looks fine on the surface. Kratter gives examples like Apple and Pets.com to show both sides of this machine. Apple became one of the greatest business success stories in history because it kept creating products people loved and built an ecosystem that became incredibly valuable. Pets.com, on the other hand, became a famous example of dot-com-era hype. Investors got excited, the stock attracted attention, but the business itself was not strong enough to survive. The lesson is clear. The market rewards real business strength over time, but it can also get temporarily carried away by hype. Your job is to learn the difference. The market looks forward, not backward. One of the best ways to understand the stock market is to think like a hockey player. Wayne Gretzky famously said he skated to where the puck was going, not where it had been. Good investors try to do something similar. They ask, where is this business going? Is demand increasing or decreasing? Does the company have a durable advantage? Can it keep growing? Is the market already expecting too much? Or is it underestimating the company's future? This is why the market can sometimes feel confusing. A company can report good news, but the stock falls because investors expected even better news. Another company can report bad news, but the stock rises because the future looks less bad than feared. The market is not just reacting to the present, it is constantly adjusting expectations about the future. 5 huge mistakes beginners make. One of the most practical parts of the book is Kratter's warning about common beginner mistakes. These mistakes are so tempting because they feel logical at first, but they can be extremely costly. Mistake 1. Buying stocks at 52-week lows. Many beginners think a stock hitting a yearly low must be a bargain. They think, it used to be much higher, so it must go back up. But this is not always true. A stock hitting new lows may be falling for a serious reason. The company may be losing customers. Earnings may be weakening. Debt may be growing. Competitors may be winning. Institutions may be selling. A low price does not automatically mean value. Sometimes it means danger. Kratter argues that beginners are often better off looking at stocks showing strength instead of weakness. This does not mean you should blindly buy anything at a high, but it does mean you should stop assuming that falling stocks are automatically good deals. Cheap can always get cheaper. Mistake 2. Trading penny stocks. Penny stocks are usually low-priced stocks, often trading under $5. They attract beginners because they look affordable. A beginner might think, if I buy 1,000 shares at 50 cents and it goes to $5, I'll make a fortune. The dream is seductive, but penny stocks are often tied to weak, risky, or low-quality companies. They can be extremely volatile, easily manipulated, and hard to sell at fair prices. The low price creates the illusion of opportunity, but often the real reason the stock is cheap is because the business is poor. Kratter's warning is simple. Do not confuse a low share price with a good investment. Beginners should focus on quality, not lottery tickets. Mistake 3. Shorting stocks. Shorting means betting that a stock will go down. Technically, you borrow shares, sell them, and hope to buy them back later at a lower price. If the stock falls, you profit. But if the stock rises, your losses can grow quickly. For beginners, shorting is especially dangerous because the risk is not as simple as buying a normal stock. When you buy a stock, the most you can lose is the money you invested. When you short a stock, the potential loss can be much larger because a stock can keep rising. Advanced traders may short stocks with strict risk controls. But for beginners, Kratter's advice is clear. Do not start your stock market journey by betting against companies. Learn how to protect capital before trying advanced tactics. Mistake 4. Trading on margin. Margin means borrowing money from your broker to buy more stock than you could afford with your own cash. This can make gains bigger, but it also makes losses bigger. That is the trap. If you buy with borrowed money and the stock falls, you are not only losing your own money, you may also owe interest. And if the loss gets large enough, your broker can force you to sell at the worst possible time. Margin turns investing into a pressure cooker. For beginners, this is usually unnecessary risk. The market is already difficult enough when you are using your own money. You do not need to make it harder by adding debt. Mistake 5. Trading other people's ideas. This may be the most relatable mistake of all. Someone gives you a hot tip. A friend sounds confident, a YouTuber sounds smart, a social media post goes viral. Everyone seems excited, so you buy. But then the stock falls. Now what? Do you hold, sell, buy more, panic? The problem is that you borrowed someone else's conviction. You did not understand the business. You did not create a plan. You did not know the risks. So when pressure arrives, you have nothing to rely on. Kratter's message lines up with Warren Buffett's famous principle: only invest in businesses you understand. Because when you understand what you own, you can make calmer decisions. When you do not understand what you own, every price drop feels like a crisis. Warren Buffett and the power of business understanding. Kratter introduces Warren Buffett as one of the greatest examples of long-term investing. Buffett's strategy is often described as simple, but simple does not mean easy. His approach is built around a few core ideas. Invest in businesses you understand. Look for companies that can survive for decades. Think long-term. Do not buy something you would be afraid to own for years. Focus on quality and durability. One of Buffett's most powerful ideas is pricing power. A company has pricing power when it can raise prices without losing many customers. This is a sign of a strong business. For example, if a beloved brand raises prices slightly, customers may keep buying because they trust the product, love the taste, rely on the service, or feel loyal to the brand. But if a business has no advantage, even a small price increase can push customers away. That difference matters. A company with pricing power can often protect profits during inflation, competition, and economic pressure. A company without pricing power may struggle constantly. For beginners, this is a beautiful way to think about quality. Do not just ask, is this company popular? Ask, can it raise prices? Do customers still stay? Does the brand matter? Is the product hard to replace? Does the company have an advantage that competitors cannot easily copy? These questions move you from speculation to business analysis. Value investing and the P/E ratio. Kratter also explains value investing, the strategy associated with Benjamin Graham and later Warren Buffett. The basic idea is to buy stocks for less than they are truly worth. In theory, if the market underestimates a company, you can buy it cheaply and benefit when the market eventually realizes its mistake. One common tool for value investors is the P/E ratio, or price-to-earnings ratio. The P/E ratio compares a company's stock price to its earnings per share. For example, if a stock trades at $200 and earns $10 per share, the P/E ratio is 20. A lower P/E can sometimes mean a stock is cheap. But Kratter warns beginners not to oversimplify this. A low P/E can also be a warning sign. Maybe investors expect earnings to fall. Maybe the company is in decline. Maybe the industry is shrinking. Maybe the stock looks cheap because the future is getting worse. This is called a value trap. It looks like a bargain, but it is actually a business with serious problems. The lesson is important. Do not buy a stock just because one number looks attractive. A low P/E is not enough. You need to understand the business, the industry, the risks, and the future. The real mindset of a beginner investor. The best part of this book is that it gives beginners permission to start simple. You do not need to master every chart pattern. You do not need to understand every financial metric. You do not need to trade options, short stocks, or use margin. You do not need to chase every trend. In fact, avoiding complexity may be your biggest advantage early on. The beginner's job is to survive long enough to learn. That means protecting your capital, avoiding obvious traps, and slowly building skill. A smart beginner does not ask, "How can I get rich this month?" A smart beginner asks, "How do I avoid stupid mistakes? How do I understand what I own? How do I build good habits? How do I invest without panic? How do I think long term?" That mindset is far more powerful than chasing the next hot stock. How to apply this book. Here is a practical way to use Kratter's lessons. First, learn the basic vocabulary. Understand stocks, market cap, brokers, exchanges, investors, traders, IPOs, PE ratios, and margin before you risk real money. Second, decide whether you are investing or trading. Do not mix the two without realizing it. If you are investing, think in years. If you are trading, define your risk before entering. Third, avoid beginner traps. Stay away from penny stocks, random tips, margin, shorting, and falling stocks that only look cheap. Fourth, study businesses, not just stock prices. Ask what the company sells, how it makes money, whether customers care, whether it has pricing power, and whether it can still be relevant years from now. Fifth, protect your emotions. The stock market will test you. Prices will move. News will scare you. Other people will sound more confident than they really are. Your defense is education, patience, and a clear plan. Final takeaway. A beginner's guide to the stock market is not trying to turn you into a Wall Street expert overnight. It is trying to do something more important: help you stop being afraid of the market, while also teaching you to respect it. Because the stock market is both an opportunity machine and a mistake amplifier. If you approach it with curiosity, patience, and discipline, it can help you build wealth over time. But if you approach it with greed, confusion, and borrowed opinions, it can quickly become expensive tuition. Matthew R. Kratter's core message is simple: learn the basics. Understand what you own, avoid dangerous shortcuts, think like a business owner, and never risk money on something you cannot explain. The market does not reward people just because they are excited. It rewards people who can stay calm, learn continuously, and make better decisions than the crowd. So before you chase a hot stock, pause. Before you buy a company because it looks cheap, study why it is cheap. Before you follow someone else's tip, ask whether you would still hold that stock if no one was there to reassure you. Because real investing begins when you stop asking, "What should I buy right now?" and start asking, "What kind of investor am I becoming?" If this summary helped you understand the stock market more clearly, make sure to like the video, subscribe, and save this lesson before you make your first or next investment decision.